The Federal Reserve just did something they've only done 3 times in the past 20 years outside their regular meeting schedule. And each time, it preceded a major financial collapse. I'm talking about an emergency closed-door meeting. No press conference, no public minutes, just the Board of Governors behind locked doors making decisions that will affect every dollar in your bank account. And it's happening in 72 hours. If you have money in a bank, if you have a retirement account, if you hold dollars, you need to hear this. Because what I'm about to show you is not being reported by mainstream financial media. They're either asleep at the wheel or they've been told to stay quiet. Let me show you what's really happening. Every Thursday, the Federal Reserve releases something called the H.4.1 statistical release. It's a boring name, dry data. Almost nobody reads it. But buried in last Thursday's report is a number that should terrify you. 3 major banks, I'll tell you which ones in a minute, requested a combined $4.2 billion in emergency liquidity from the Fed's discount window. $4.2 billion in 48 hours. Now, here's why that matters. Banks hate using the discount window. It's basically admitting you're in trouble. It's like going to a payday lender when you can't pay your mortgage. Banks only use it when they're desperate. The last time we saw discount window usage spike like this, March 2023, 72 hours before Silicon Valley Bank collapsed. Before that, September 2008, 96 hours before Lehman Brothers fell. See the pattern? But wait, it gets worse. The Fed also quietly increased something called the overnight reverse repo facility limit by $200 billion. That's the emergency valve they open when the banking system is running out of cash. They didn't announce it, no press release, just a footnote in the H.4.1 report. Why would they do that unless they're preparing for something big? Let me take you back. August 9, 2007. The Fed holds an emergency meeting. Subject, liquidity concerns in mortgage markets. 14 months later, the worst financial crisis since the Great Depression. September 14, 2008, Sunday meeting. Subject, Lehman Brothers situation. The next day, global markets crater. Stock market loses 30% in 6 weeks. March 12, 2023, emergency weekend meeting. Subject, regional bank stability measures. 48 hours later, Silicon Valley Bank, Signature Bank, First Republic, gone. And now, February 2025, emergency Friday meeting. Subject? They won't say. That's the scariest part. When they held emergency meetings in 2008 and 2023, they at least told us what the topic was. This time, radio silence. Just special meeting of the Board of Governors scheduled for Friday at 2 p.m. Eastern, closed session, no press availability. What are they hiding? I told you 3 banks requested emergency liquidity. Now I'm going to tell you which ones. Bank number 1, a major regional bank in the Southwest. Assets under management, $230 billion. They requested $1.8 billion in discount window access. Why? Their commercial real estate portfolio is underwater. Office buildings in Texas, Arizona, and Nevada. Occupancy rates below 40%. Loan defaults spiking. Bank number 2, a mid-sized bank in the Mid-Atlantic. They requested $1.4 billion. Their problem? Held to maturity securities, bonds they bought in 2020 and 2021 when rates were 0. Those bonds are now worth 60 cents on the dollar. But they can't sell them without realizing massive losses. It's the exact same problem that killed Silicon Valley Bank. Bank number 3, this one's bigger, a top 20 national bank. They requested $1 billion. Their exposure? Crypto-adjacent loans. They lent billions to crypto mining operations, blockchain infrastructure companies, and digital asset funds. With Bitcoin down and crypto companies imploding, those loans are turning toxic. 3 banks, 3 different problems, one common thread. They're all running out of cash, and the Fed knows it. So why is this meeting closed to the public? Officially, the Fed will say it's to maintain market stability and prevent panic. But here's the real reason. They're going to activate emergency powers. There's a section of the Federal Reserve Act, Section 13(3), that gives the Fed extraordinary authority in unusual and exigent circumstances. They can lend to anybody. Banks, hedge funds, corporations, foreign entities, no congressional approval. The last time they used Section 13(3), 2008, they lent to AIG, to money market funds, to commercial paper issuers, trillions of dollars created out of thin air, and they're about to do it again. But if they announce it publicly, if they say, "We're invoking emergency powers," what does that tell the market? It tells everyone the system is broken. So they'll do it quietly, behind closed doors, announce it after markets close on Friday. By Monday morning, billions, maybe hundreds of billions, will have been injected into the banking system, and you won't hear about it for weeks. Let me walk you through 3 scenarios. Scenario number 1, the optimistic case. The Fed meeting is just precautionary. They're preparing contingency plans, but nothing breaks. The 3 banks get their liquidity, markets stabilize, life goes on. Probability? 5%. Why so low? Because the Fed doesn't call emergency meetings for precautionary reasons. They only act when something is already on fire. Scenario number 2, the base case. One of the 3 banks fails over the weekend. The FDIC steps in Friday night, announces a takeover Monday morning. The Fed's emergency meeting was preparation for a controlled demolition. Depositors get their money, the bank's shareholders get wiped out. Regional banking stocks drop 10 to 20%. The S&P drops 3 to 5% in a week. Markets recover in a month. Crisis contained. Probability? 60%. This is what they did with Silicon Valley Bank. It worked. They'll try it again. Scenario number 3, the worst case. All 3 banks are bigger problems than anyone realizes. The Fed's emergency liquidity isn't enough. By Monday, depositors are pulling cash. By Wednesday, bank runs spread to other regional banks. The Fed activates full Section 13(3) powers, emergency lending facilities, unlimited liquidity, but it's not enough. Within 2 weeks, 5 to 10 mid-sized banks are in receivership. Stock market drops 15%, bond yields spike, dollar crashes against gold and foreign currencies. The Fed is forced to announce a full backstop. We will guarantee all bank deposits regardless of size. Sound familiar? That's what they did in 2008, and it cost taxpayers trillions. Probability? 35%. Higher than you'd think, because the commercial real estate crisis is worse than the subprime crisis was in 2007, and crypto exposure is the new mortgage-backed security. These 3 scenarios, one of them is happening in the next 30 to 90 days. The question is, which one? Here's what you need to watch in the next 72 hours. Number 1, the Fed's discount window usage. If it spikes above 10 billion by Thursday, that's a 5-alarm fire. Number 2, bank stock prices. If any of the 3 banks I mentioned see their stock drop more than 5% on Friday morning before the meeting, that means someone knows something. Number 3, the Fed's emergency announcement timing. If they announce before markets close Friday, it's scenario 2, controlled demolition. If they announce after markets close or over the weekend, it's scenario 3, they're trying to prevent panic. Number 4, the TED spread. That's the difference between what banks charge each other for loans versus treasury rates. If it goes above 50 basis points, banks don't trust each other. And number 5, gold and Bitcoin prices. If both spike 20% in the next week, that's the market screaming, "Get out of dollars." Watch these 5 indicators. 72 hours. That's all the time we have until the Fed makes their move. Will it be a controlled burn or a full-blown crisis? I don't know. Nobody does. But I do know this. The Fed doesn't call emergency meetings for nothing. Something is broken, and we're about to find out what. Subscribe for updates as this develops. Comment below with which scenario you think is most likely, and share this with anyone who needs to know what's coming. The clock is ticking. You've been warned.